We are keeping our eyes, of course, on the markets, and all eyes focus on Janet Yellen. The markets do seem to be trading a little bit lower since her speech this morning at 10 a.m. She did say that she sees the economy is nearing the Fed's goals. For a look at what this means for all of us investing, joining us now is Bob Iaccino. He's the Chief Market Strategist at Path Trading Partners. Bob, good to be with you today. You and I were talking during the commercial break, and I said, what's going on? Anything going on? And you said, are you kidding me? Tell me.
I don't know what I'm going to do with this Fed. I don't know what to do. I don't want to disparage anyone's intelligence on the Fed because I don't know what they're saying behind closed doors. But I think one of the main jobs of a Fed chairman that I think, at least to date, Janet Yellen has not, let's give her a C on, would be communication. I know they're supposed to be transparent, they're supposed to be apolitical, and I just don't think that's coming across. We do a podcast, and we were recording our podcast this morning as headlines of her speech were scrolling on our screens, and the first thing I said was, this is rate hike talk. When I saw the first couple of headlines, I said, they're hiking rates, this is rate hike talk. We're going to get the first pre-election rate hike in forever, at least that I can remember. It's coming. And then as the comments came out, you saw the dollar strengthen off of that, you saw the S&P fall, then you saw that reverse, and you saw dovish comments coming out. This would be a dovish speech for anyone else. It was hawkish for Janet Yellen. But I don't think the communication is there. You had to have Stanley Fischer clarify that her comments said that a September rate hike is still on the table or very much in play. It's just too confusing.
And that's probably why we've seen the markets range bound for so long now. And I wonder, you give her a C for communication. I'm almost thinking give her an A. I think that they're communicating exactly what they want to communicate. And every time the markets get a little bit too stretched for them from a valuation perspective, because let's face it, we all talk about stretched valuations, that then they pull it back. But they keep it range bound so that we know that, that it's still possible.
So that sounds to me like you're giving them an A in history when they're in a math class. They're not supposed to be looking at the asset values, although they do. It's not part of what they're supposed to be doing. They're supposed to tell us where, or at least set a target Fed funds rate. One of the comments that came out today out of Janet Yellen's mouth was, some would say that zero is a neutral rate given the circumstances. She also said we're approaching full employment and we're approaching price stability. So if we weren't approaching those things, if we were in a recession, what is stimulative? Is it zero? Is it buying stocks? Is it negative? I mean, it's completely against what they've been saying when you take the totality of the comments. So she definitely helped the equity markets in the second half of her speech. But I think what's happening is the market right now, or at least prior to the sell-off we just had, didn't believe the Fed would raise rates. I now do.
Is that why the markets then are drifting lower? The markets are telling us that the economy is not ready for a rate hike and that it would be a mistake? I mean, it's a drift lower. It's not a major move, but what do you think?
No, it's a drift. Well, here's where I think you've hit it right on the head, Catherine. I'm going to buy these dips. If we're selling off because the market believes there's going to be a rate hike. And if you look at when we started to go negative, it was after Stanley Fischer's comments, which said September's on the table. So that was just kind of a classic baseline fundamentals trade. And I think what's happening now is the economy is strong enough. I think profits are going to get better. I think the consumer's going to get better. And I think there's professionals out there, money managers and funds that will buy these dips going forward. I think they're looking forward to these dips. So if we get dips on rate hike fears, those are dips I want to buy.
Bob, why do you think the economy's getting better? We had a worse or negative revision to Q2 U.S. GDP. Retail sales are weak. We've had 4 to 5 quarters of negative profit growth.
I think bricks and mortar retail is weak. Walmart was strong. Dick's Sporting Goods was strong. Amazon was strong. GDP, I think, is crap now. I really do. It gets revised over and over again. It just doesn't seem to reflect the economy. But I think jobs are strong. We saw a really good durable goods number, 5th increase in a row. We saw capital spending increase 2 months in a row in the durable goods number now. Now, that's granted a very specific area of the economy, but we're starting to see more than just green shoots. It's not going to be a 5% economy. It's not going to happen. But if we can rally stocks 61% since February of 2012 with a 1.5% to 2% economy, if we can get it to 2.5% to 3%, I think stocks go up.
That's interesting. So your advice to our viewers today, buy these dips, go long equities.
Yes.
What about fixed income? pare back fixed income?
Yeah, I mean, I guess you should, because if you're not in cash or in fixed income, there's more money on the sidelines than I've ever seen, and I know I'm not seeing all of it. So a lot of that is probably in fixed income.
Okay, Bob.
But
Bob.
Go ahead. No, please.
Oh, I can't.
Yes.
You know what? I've got a window. I've got to let you go. I'm going to have you back, though. I have an important question.
Please.
We'll talk to you soon. Thank you very much for joining us. Happy Friday. Have a good weekend.